Okay, welcome. Wonderful to have you all here. And I want to get you nice and live here with our data center launch. So it is very, very exciting for me that we are about to share and unveil something that we've never done before. So data centers is something that I have been scouring the planet for the last 18 months. I know that so has Alex, so has Paulo. All of us have been trying our best to, and we've been talking to Ryan for a long time about actually doing it. Just before we get started though, we're not going to be giving you financial advice. We are going to be sharing with you our information, our best insights, but one does need to take into account the risks that are clearly on the platform in terms of that process. Now, I wanted to share with you a little story about data centers. So Alex has an investor who's part of our platform. He's actually a shareholder in our company. He comes from Singapore. He manages about $5 billion. And he came and he presented to our mastermind in January 2024. And he taught us about data centers. And I have to say, my mind was blown. And the reason being, and I've made some crib notes here just to share with people. And I think what I'll do actually is let me stop sharing so you can see me properly. So a couple of things that I thought were really interesting. Generative AI workloads require 10 times more computing density and energy than legacy cloud systems, creating a demand for AI. So my takeaway from this was, with cryptocurrency, with tech, with AI, with the internet, with literally everything, the demand for data centers is doubling every 6 months. That's exponential demand, okay, in terms of where you're going. And then you've got supply, and supply is constrained. And the reason being is that the average data center runs the same amount of power as 100,000 homes. So 100,000 homes, the amount of electricity it uses in a year, a data center uses in a month. Okay, now use common sense here. If you're a politician, do you want to be signing off these data centers over here? So supply is constrained and demand is growing exponentially every 6 months. And when I understood that back in January 2024, I was like, this is a no-brainer. And for me, if you take that old proverbial, when there's a gold rush, don't go out and try and find the gold, sell the spades. Well, if you think about it, whether you're into crypto or AI or literally anything on the internet, every single thing has to run off a data center. And the last thing that I think is really, really important here is that as a real estate asset, you've also got very sticky tenants in terms of the whole process. So I'm going to pivot over to our partners here and we'll go through this. But I just, for me, when Alex and I sat there in our mastermind back in January 2024, I was like, you got demand doing this, you got supply doing this, you've got really, really solid tenants that are looking after it. And with this exponential demand, it really made sense to me in terms of one of the asset classes that we wanted to be in, certainly, really putting energy and effort into it over the next, decade and more. So it's with a huge amount of excitement that I bring Ryan and Tyler here to come and join us. I don't know, Alex, if there's anything you want to say just before we pivot into Ryan and Tyler with regards to this opportunity. I know that you and I have been scouring the planet, as I said.
I'm bursting at the seams with excitement. So don't make me talk. Let's hear these guys. I'm quite keen to understand a little bit more. I got a whole list of questions, but yeah, I'm really keen to understand and hear what it's all about. I've been chatting to investors all day. Literally, my ear is singing still from all the chats. So yeah, and I see many of the names here. Welcome, and yeah, I'm very excited that we're here. It feels like it's been years, Scott, that we've been fighting for this. So yeah, really, truly excited.
Awesome.
Yeah.
Well, without further ado, I think what I'll do then is let's pivot to Ryan and to Tyler in terms of the process. Now, when I do these webinars and when we do deal launches, I normally start with what's the macro, what's the city, what's the asset class, etc. I have that, but let's not come and listen to me. We've come here to listen to our partners on the ground in America. So I met Ryan about 3 years ago. We've done 3 commercial deals with him already in terms of this process. And about a year ago, he started talking actually to our CFO, Paulo, about what he was doing and some of the changes that he was making in terms of where they were going with data centers. And I have to say, we've been really keen. We've been sort of keeping quietly in the background going, what's happening when, because patience isn't something we were born with. But Ryan, it's with a huge amount of excitement that you're here tonight. I know we were speaking literally last week and you were like, right, everything we've been talking about for a year has finally got the green light. And we've been able to, all of us, turn this around pretty quickly because I know that opportunity waits for no one. But I want to hand over to you and tell us why you're so excited about this and what is happening in the sector.
Yeah, yeah. Thank you so much, Scott, Alex. Thank you guys for having us on. Always an honor. Love working with you, gentlemen. Yeah, everyone. So, you know, first of all, we founded AltSpot to bring institutional opportunities to retail investors, and what that means is the top quartile opportunities. These are the largest firms within the United States of America are typically reserved to institutional checks, meaning if you're not writing a $10 million plus check per asset class, you can't even pick up the phone and talk to the Sequoias, the Benchmarks, the Blue Owls, the conglomerate monsters in America that kind of have a handhold on all these deals. And ultimately, unfortunately, the top quartile of these deals, significantly outperform the middle and lower quartile. So we launched this company to diversify that. I have a fantastic network. I've been very fortunate. My father-in-law founded Northgate Capital, which is a 5 billion AUM global venture firm. And through his network, I've been able to connect myself with a lot of power players in the States here. So I say all that to say this is part of that opportunity. We were able to bring, this is an institutional level deal. There's a lot of people talking about data centers, guys, and data centers are the demand here. This would be, like getting into software engineering in 1984, right? So this is the demand. Software is called up. There's not a lot of moat in software now, but hardware hasn't. So software is no longer the issue. The bottleneck comes to hardware, and the biggest bottleneck, the base of that, is the data center. Data centers are needed. Anything AI, 5G, anything to spread technology, empower technology, has to start in a data center. And currently in the United States of America, the demand of AI is overpowering data centers. They're cutting off service providers. Most data centers, the average data center in America is 10 years old. So you could imagine trying to run, a VR game, a virtual reality game on an iPhone 6. It just doesn't happen. So this technology has to be updated. Unfortunately, the current data centers are not. AI creates significant amounts of heat and pulls significant amounts of energy. So it's not feasible and affordable to run, just a retrofit and put the new technology in the current standing data centers. They have to be completely redesigned. They use heat recapture, geothermal technologies to make these things cost effective for these large tenants. So there's a lot of talk about data centers, but actually doing these from scratch take very big, very sophisticated institutional teams. And, that's what we've been ultimately able to plug ourselves in with here. And that's what we'd like to bring to you guys. So this opportunity, I'm going to pull up just some slides here, if that's okay with you, Scott. I'm just going to share my
Please
screen.
do. Just share your screen.
Let me see here. All right, desktop one. Sorry, let's see here. Okay. Do you guys see the deck here?
Yeah, we got it.
Wonderful. Okay, so as I stated, this is kind of what these data centers look like, guys. This is a rendering, but just so for your understanding here. So this is the data center like they typically would be. You notice there's tons of solar on the roof. This is a microgrid. If you can see my mouse over here. The key to these data centers, again, there's a lot of companies popping up with wanting to get into data centers, and frankly, many of those will fail. And the reasoning is current top tier tenants, which are you want tenants AWS, which is Amazon, Alphabet, which is Google, Oracle, Nvidia. These are the tenants, Meta. These are the tenants that power these data centers and are able to create significant income. These are very expensive builds. You're looking at $200 and $300 million builds. You can't risk a small mid-sized company coming in to pay for this data center. These are very expensive slots. $90 million in rent per year to power one of these. So depending on a lot of smaller companies is just not feasible. So in order to target top tier tenants and create the most value, if you are able to build a $200 million data center with its own microgrid that meets the efficiency standards, the redundancy standards, and the latency standards, that means uptime, proving that they're not going to have downtime with generators and things like that, as well as latency, just the speed standards. On a conservative estimate, a $200 million data center with, let's say, Alphabet on a 15-year triple net lease is worth about $1.5 billion. So you see the immense value creation by just like triple net real estate is valued purely on the tenant that's inside the building. So if you land a tenant like Google on a 15-year net lease at 90 million a year, you've created a pretty significant value jump from 200 million to build to 1.5 billion in worth. So you can see how that would be very attractive. In order to do this, this is kind of what Scott was saying, compute can't scale. So we all see the problem here. And in order to do this, there are many steps that have to be taken. We partner with Overwatch Capital, which is actually my father-in-law is a managing partner at this firm, which is the only way we were able to get retail investors inside an institutional deal like this. On the project level, these deals are backed by large private equity firms, large check writers. And what this investment is an investment in the platform company. So this is an investment right into Overwatch Capital and in their platform, which is going to hold various data centers, various campuses with their own microgrids, and servicing the top tenants in the top tech tenants in the United States of America. So that's who Overwatch Capital is. These are the current. We own these data center assets right now, so you can kind of see these are all 70 to 100 plus megawatt capable buildings. If you'll notice the acreage beside these aren't just the buildings, right? So you have obviously the 150,000 square foot building, but 10 acres, 230 acres around this one. The reason that acreage is vital is so you can build out these microgrids. Microgrids give us the ability to be carbon neutral, which we're using gas on all these right now because efficiency is really important. These tech companies, every month that goes by, they're losing billions in being able to get into these data centers and provide, power their AI builds, their model trainings, et cetera. So, speed is a factor right now. And so we are still using natural gas. While wireless being able to create our own power with the microgrid, we'll be able to actually arbitrage and sell the power back to the grid. And there's a lot of tax credits that come through as revenue, and also some arbitrage there selling the power back. So these are the kind of buildings we'll be managing. Overwatch Capital will be the managing partner here. They'll build these out and they'll lease them out to top tech tenants. Currently, the Dallas-Fort Worth facility is finalizing their lease with CoreWeave. CoreWeave's a major data center occupier. The Ohio property currently is going through lease negotiations with Oracle, which we all know. We just had a meeting with Meta. Alphabet's also at the table. Alphabet's Google. So these are top tech tenants that we're working through here. Now, a couple questions typically come up. One, why would Google not build its own data center? And it's a great question, and they absolutely are. Google's absolutely building its own data centers, but it can't build them fast enough. They're not a real estate developer. It takes the relationships and time and effort. These aren't just, hey, you prop the building up and move in. The technology required, the microgrid partnerships. Google simply that they're a tech firm. They don't have all this on hand, so they're scaling this side of their firm as fast as they can as well. But also, once these things are built and there, then they're there, right? So Google doesn't want to have to build a whole real estate arm. So it's more cost effective for Google to try to build its own, but also partner with somebody that can provide these data centers for them. And the more the merrier. These large companies want to have as much data center growth space as they can possibly get due to the growth and demand of AI, which is, Scott showed some of the metrics on these are mind-boggling how fast this is growing and how urgent the need is. Following so far, guys, any questions so far?
Nope, perfect.
Great. So
what we'll do is if anyone's got questions, Ryan, what I suggest is you go through your flow, and if anyone's got questions, we'll go to the end. So just type them in the chat box if anyone's got questions. But I think let's
That'd
keep
be
it
wonderful.
going.
Yeah, and guys, and I know it's a lot of information, guys. These are pretty dense projects, and I'll do my best to keep it as succinct as possible. But so here's some tenants that are at the table. You can see here, obviously, these are all top tech tenants. That's our goal here. There's approximately 3 companies in the United States of America right now that have the capability of providing a data center that meets top tech tenant specs and also has microgrid carbon net zero capability. What I mean by that is, even though we're using natural gas now, we have the technology to be completely carbon neutral. That means we don't rely on a grid. We power these completely by ourselves. Very important for public companies. One, for narrative. They want to be able to say, hey, we're going to be carbon neutral by 2035. But right now, at this moment, even though we have that capability, they don't care. They're just like, hey, we need the fastest route to get into these. And so that's what we're providing. That's why we're using natural gas alongside our microgrid. So big holdup on these. Scott mentioned that we've been going back and forth on these. I've been saying, hey, we're trying, we're getting there. We got to de-risk this a little first before we jump in. These are large political level. There's so much red tape involved. This is not the type of deal that your average real estate developer can get in on. This is equivalent to building a 60-story skyscraper in Manhattan and doing it 5 times, right? This isn't something that you can do without immense levels of connections and sophistication. A big holdup for us was that even though the partners that run Overwatch day to day are multiple IPOs on the team. I'm gonna flip to this slide. I'll come back to this, but I want to show you this really quick, just to kind of give you the sense of the sophistication level.
Just by the way, this is the most incredible slide I think I've seen. I always say who you partner with is the most important thing when it comes to protecting your capital and growing your capital. And look at the experience of this team.
Yeah, it's got, and especially on a deal like this, it's like, hey, you can go with an emerging manager and maybe make some more money on a small development or something like that. But this is not one of those plays. This is not something that you want to be entrusting to anybody. I've worked across venture, private credit, commercial real estate. I've led and acquired more than $200 million of real estate in my career. I've advised on more than $1 billion in transactions. Tyler has led various ventures, was a multi-time founder, but these projects are well over our ability or connection level to be able to build. This project that we're investing in is a $2 billion project. So if you look here at the Overwatch management team, they have significant commercial and industrial experience, $3 billion of capital deployed. So this is equity deployed, not including debt and things like that, with an average IRR of 38%. High tech sector. So these are other data centers and VR systems. So there's $220 million of capital deployed there, with 144% IRR, that's showing the demand of these data centers. These were smaller projects than this one is, but this is also proof of success in this sector. Renewable power projects, $300 million of capital deployed, 19% IRR. Venture capital, this is my father-in-law's firm, so they manage $4.8 billion with a 24% IRR for actually long-term, very very steady gains, which are not always seen in venture. And of course, they've had some IPOs at $4.3 billion and a 437% IRR. It's actually Grand Canyon University's a Harvard case study now, one of the more successful IPOs in American history. So, you're looking at a team here that this is the kind of team it takes to get these done. Like I said, 2 to 3 companies in the entire United States that have this ability. What makes Overwatch special? Why do I like Overwatch more than the other companies? What makes Overwatch special is they own a proprietary technology with their modular data center racks. And now people will catch on to this and other people will start using them as well. But right now, they've demoed how fast they can build out in some of these data centers they already own. These modular racks are a specific technology that they're using. Frankly, it's not my expertise, so I can't dive into exactly how it works. It's more technical than my small brain will allow me to break down for you. But the point is they're able to scale these data centers, 50% faster than other people on the market right now. And as I said, speed is key to these top tech tenants. Going back to what I was saying though, Scott, we've been going back and forth. I've been telling Scott, hey, we're almost there. Hey, we're almost there. The big thing was, even with this powerful team we had, securing a top tech tenant will not sign with you on a data center unless you have a long-term gas relationship locked in. Meaning, you can't exactly go to PG&E, which is a big gas provider in America, and say, hey, I want you to lock me the price on 15 years of gas for, a 300,000 square foot building. They're going to say, sure, let's see your balance sheet. To do something like that, the balance sheet requires about $10 billion. So although the partners are all very successful, a $10 billion balance sheet's a pretty big one. So they didn't have that relationship. Recently, what propelled this project forward is we locked a relationship and a contract with, and it's under very strict NDA. A lot of these things, you'll notice there's not many companies that can service it. It's very private in how they're operating. They don't want other people getting in and getting a slice of the pie. So a lot of this is pretty strict. But this is a large Japanese energy conglomerate doing 100 billion in revenue. They're a large public company, one of the top 20 largest companies in Japan. And they put up a $30 billion balance sheet to lock a gas contract, which created this investment opportunity. So this investment opportunity, of course, project per project in each one of these data centers, there are going to be large institutional partners investing in the equity. Banks like JP Morgan will lend a total of $1.5 billion, which gives you some surety. A bank lending $1.5 billion across projects has, a very, very significant level. This isn't a $5 million loan. This has very significant level of diligence, that the bank goes into. They don't write a $1.5 billion check loosely. And then you're looking at, some of the Blue Owl, some of the largest firms in the world investing project per project. So you're kind of riding that diligence. What we created here is this Japanese energy conglomerate said, hey, we're going to arbitrage some of the gas to make money for us putting up our balance sheet in these gas relationships. And what we would like to also do is participate in the upside. We want to be a partner and invest in the platform company. So that company is writing a $30 million check to invest in Overwatch Capital's platform company. And we are the only other investor in that round. That means we're coming right in under we're squeezing about $2 million right in under this big Japanese energy conglomerate under the same exact terms. Why do we get that opportunity? Purely because of the familial connection here, and we utilize and leverage our relationships with a lot of big players. We have a handful of strategic partners, my father-in-law being one of them, but a handful of strategic partners that are multi-billion dollar multi-billion dollar fund managers, very renowned allocators, early investors in deals like NVIDIA. My father-in-law is a B round investor in NVIDIA. We have early investors in Uber, Meta, or Facebook at the time, and many, many other large companies. So we leverage these relationships. These are strategic. They do get some upside for bringing deals to us as well. So ultimately, we're getting to ride right behind, this oil and gas energy giant under the same exact terms. So it's a pretty impressive opportunity. I'll wrap this up here. The opportunity is it's a revenue share opportunity. Basically 0.36% per $1 million we invest is the revenue share we take. So Overwatch Capital, highly incentivized to make money. Obviously, that's what they're here to do. And every top end revenue, every dollar they make, we get 0.36% per million invested coming back to us, which brings us to outcomes here. This is just a project level. Remember, we're investing in the Overwatch management GP company, right? So we're investing in the general partner. Every time they make money, we make money. First, actually, we're at the top. So we take revenue. This isn't net profit. This is revenue of the GP. But this is just an example of what a project level deal will do to show you the kind of cash flows that these companies can produce. So this is just a single site. You'll notice stabilized revenue on these being about 90 million per year. So that's about a $20 million per year NOI. So that means Overwatch, the company, is able to produce, after paying everything, they're able to produce a $20 million net profit. So at a fully expanded level, so this is 4 sites, phase 2. We can go up many, 7, 8, 9 sites, but this is just a kind of a near-term projection based on 4 sites and fully occupied data centers. These data centers are very large, so you'll actually sell, 15 megawatts, 20 megawatts, 20 megawatts. You'll sell it in like 20 to 20 to 20 to 50 megawatt chunks. Oracle's actually at the table to get 100 megawatts. But sometimes these buildings will have multiple tenants in them because they may not need the entire space at this moment. So you can see here, revenue with 4 sites fully built out jumps to about $320 million a year with $80 million of NOI. So it kind of gives you, the picture here of what kind of income these triple net properties can produce. This is going through. We're finalizing the lease with CoreWeave. We've got Oracle and AWS, at the table now at the other properties. They'll initially will build out 15 to 20 megawatts and continue to expand those over the next 2 years. Let's see here. Sorry, I'm just going to try to find my slides. Okay, so this is a good example of how this looks. How does this rev share look? So you'll notice. Obviously, this is based on $1.5 million, just a arbitrary number. The percentages are still the same, and the multiples are still the same, regardless if it's 1, 2, 3 million. So when you're looking at based on $1.5 million, obviously nothing in the first year. This period they'll be actually constructing. They'll have leases signed. They'll be starting to construct the data center. These are large, $200 million projects. So that, they're not fast. It does take some patience. 2027. Now at this point, there is. Where we're starting to wrap up construction and there is starting to be some income coming in. But remember, we're getting paid from the GP share. So the investors, the large institutional investors at the project level, they have a preferred return hurdle. So they have to make their preferred return before the GP starts making money. You see that start happening in 2028, where we get some, we start getting some cash flow back. Naturally, we do have, so we will make some money in 2028. The check won't be, very large at this point. So it'll just accrue in the account. Obviously, they're not going to wire, small checks out until they're significant enough to send. In 2029, we get about a quarter of our money back. So this is just a full data center up and maybe a couple data centers partially. There's a couple leases signed and they're partially tenanted. This isn't phase 2 where the whole thing's occupied, but we've got a few tenants in data centers, and you start to see, we get a quarter of our money back in 2029. 2030, you'll get about half of your money back. This is at this point we've started phase 2. As soon as we get these things fully occupied, we put them on the market to sell them. These things will sell. Selling is no issue. Once you have a data center with, a 15-year lease with Amazon, any large institution in America will fight you to buy it. These projections are based at a 7% exit cap. I would challenge you all right now to go to Google and just type in on a Google browser, what is the typical cap rate for a Google occupied AI capable data center, and press enter. When you do that, you're going to notice that it says typical exit cap rate for these data centers is 4 to 5%. It may say 4 to 6% exit cap rates. Your cap rate, the tighter the cap rate compresses, the more money, that there is to make, the more expensive the data center is. These are projected at a 7% exit cap exit. So I would call that highly, highly conservative. I've underwrote hundreds and hundreds of millions of dollars of industrial properties. Typically a strong middle market company, let's say doing 500 million in revenue, a company you've never heard of that's making components for submarines or something like that, will project at a 7.5 to 7 cap exit. So a Google lease property on an AI capable data center with its own microgrid could be significantly sold. It's probably sold at a 4 or 5% cap, especially in the coming better debt market in America. It's institutional standard to model it. We don't want to sell moon rocks. It's institutional standard with institutional teams to model these things highly conservative. Different than smaller firms that'll kind of, sell the best case scenario because they have to attract people. There's no problem attracting people on these deals. Everybody understands the sophistication and the need. So it's standard to show kind of, hey, this is our base case outcome. Going back, you have 2030, get about half of your money back. You'll notice we start selling more assets in 2031. you 3x your money. And then as you'll follow it all the way to 2034 here, where you get a projected 7x return on your capital, which is very significant. This is real estate downside risk protection. They have and own these assets. They can sell these assets, in a worst case scenario. And so this is real estate downside protection with venture capital level upside. This If these properties were to exit at 4, 5, 6 caps, even at a 6 cap, you're looking at about an 8.5x multiple. And that math continues,
Just to be clear, Ryan, I think it's just important for everyone to understand what that means. So when you say a 3x, just to put it in perspective, to keep the math simple, if someone puts in $100,000, if they're getting a 3x return, they're getting out $300,000. I just want to just make it simple for everyone, just to understand the maths of what you're saying. So if it's an 8 times, if you put in $100,000, you're getting out $800,000. I just want to, it's important people just, I know it sounds very simple, but I just want to make sure people understand that.
Yeah, no, absolutely. Absolutely. Yeah. So exactly, guys. So this is turning, this is moving the needle, is what we like to say. This is turning 100,000 into 700,000, at very, very conservative base case. Now, that doesn't mean there's not risk. Of course, there's risk. These are very large projects. There's construction risk. This is typical real estate development risk, albeit with, a highly institutional, highly capable team who've developed billions of dollars of real estate. And then ultimately, a team that has a lot of time and personal capital on the line. They put up personal capital to obtain these data centers, and as you can imagine, an empty 350,000 square foot building on the outside of a large American metro is not cheap. So, significant incentive for them here to make money, and they can't make any money in this opportunity without us making money. Every dollar they make, we get a piece of. And so, yeah, this is showing kind of some of those exit values. We talked about this slide. And I'll kind of slide just quickly. You guys, Scott has this, and you guys can go through and kind of read and Google on. All of these partners are I say Googleable, which means they're all pretty renowned. You can Google any of these names, and they'll pop up. So you see some guys here that have done some pretty impressive things. Kind of roll through some of these. All these guys built data centers in technology, and have very, very personal relationships. My father-in-law was actually this weekend at dinner with Andrew Bosworth. They call him Boz. He's the CTO of Meta. So we actually were at dinner this weekend with him, talking about Meta coming into some of our data centers. So these guys are well connected, been investing alongside these companies for a long time. Kind of see the power. We've got some guys in advisory. Chris Volk was the CEO of Store Capital, took them public in 3 years, 15 billion AUM. He kind of invented the middle market sell leaseback model. Very, very sophisticated institutional guy. So guys, that's the opportunity. I know that's a lot to unpack, but high lines are data centers, enormous demand. Unfortunately, pulling off a data center in America right now requires highly, highly sophisticated institutional teams with top tier build technology and understanding microgrids and how these things go together. And they have to pass the specification of Google's top engineers, Amazon's top engineers that come in and feel confident about paying $90 million a year. You can imagine the diligence that goes into that. And the fact that we've not only secured, leases and secured these relationships, but also have secured financing for these on a project level, kind of shows you, how sophisticated this team is. On top of that, you're not riding my diligence. You're coming in at the same exact terms in the same exact position as a $100 billion Japanese energy conglomerate. You're getting the same deal, and that provides a lot of diligence in itself. We're just kind of riding this wave. And then ultimately what you have is a company that has real estate downside protection, owns data centers, and will build these out, operate them under triple net leases, which means they're not liable for anything. They're not liable for the roof. They're not liable for power. The tech tenant inside will have to cover everything. The risk here, is there risk? Of course there is. There's always risk. The risk in these kind of deals is operational, the construction. These are existing buildings, but we have to retrofit these for data centers, build out the microgrids, tie all that together. And there is, traditional construction risk, albeit, typically you'll take real estate development risk for a 2x upside. Your optimistic outcomes here are, 9, 10x. possibilities. So you are taking standard, this would be a good deal if I came in and said, hey guys, we're going to develop some real estate. We're developing a beautiful industrial facility. We've got a large manufacturer signed, and you're going to 2x your money in 5 to 7 years. That'd be fantastic. I'm coming in and telling you that, hey, there is construction risk, but there's opportunity to 10x your money due to the demand of these data centers. This is the infrastructure of the United States of America in the future. This would be like investing in fiber optic cables in 1990, right? So this is an absolute. There's no economic shift. There's no cyclical cycle that's going to change the demand of data centers, short of the United States of America collapsing. So this is these tech tenants need this stuff to grow. Billions and billions and billions of dollars are on the line, and you're investing here in one of the top 3 companies in the United States of America with the capabilities to do this. So I do think it's a fantastic opportunity. This is a true institutional, a large multi-billion-dollar institutional firm only sees a couple of these deals like this a year, and we're able to provide access to it through our platform for retail investors. Be an honor and a pleasure to have you guys on board, and would love to answer any questions. And that was a lot.
Ryan, firstly, thanks very much. Really appreciate it. I think I'd like to just keep up what you've got there, because I've read everything, and I wanted to properly understand, what does it mean that Overwatch is positioned at the center of the most critical bottleneck in the global economy, power and compute? So let's just unpack that a little bit. Basically, I think I know what it is, but I'd like you to explain it just to make it clear for people.
Sure. So yeah, the service providers currently simply can't run AI. So you got to think about, Scott, there's these data centers are now in America, the vast majority are owned by large real estate REITs. And what that means, the public real estate company that you can buy on the stock market, and these companies like Store Capital, these companies own and operate these triple net data centers that have been 100% occupied for years, right? Most of this technology is old. And when I say old, it's like the average data in America's technology inside of it's 10 years old, which doesn't sound very old, but that's ancient in technological terms. Think about what your phone looks like 10 years ago versus even what it can do, what it's capable of now, right? Compute, I have as much power in this laptop that I'm speaking to you right now on as a large company data server had 15 years ago, right? So I think I was looking the other day on the largest Apple laptop. Now you can download almost every movie on Netflix or something like that. So technology grows extremely fast. So what the issue is AI has substantially, the demand was already getting pressed, but these companies, it's like, imagine if you owned an apartment in Los Angeles and it's 100% occupied. Why would you go renovate all the rooms? You're already making great money. There's no reason, there's no incentive for you to go in and completely redo the entire apartment complex. So these things haven't been renovated. They've not been updated for years. But the issue is, as AI launched and grew exponentially, and every company had to get their hands on it for training models, for operating it, the power on these grids went from being a little outdated to completely useless to power AI. Too much heat, it shuts them down. The whole data center falls. When the data center falls, these large tech companies are having gaps in their power. They're not able to service clients. You can imagine how we get so dependent on Apple Maps. If Apple Maps doesn't work for a day and a half, you're going to go to Waze, right? These are billions of dollars of loss. If Google doesn't work could you imagine how you would feel if Google didn't work for 2 days? That's not something that we're accustomed to. People would lose their minds, right? Google can't afford to have outages. And these data centers are cutting off because they can't control the heat and the power of AI. And then even if they don't cut off, it is wildly expensive because of the power pool. When they're pulling from the grid, they're creating so enormous power pool, and it's becoming not cost effective. So this bottleneck, thus we have a bottleneck, right? So these AI capable data centers are able to create their own energy, making the power a lot more efficient, sell that energy back to the grid, creating more revenue, get something that's called ITC tax credits, which are, government is incentivizing microgrids and power creation, which comes back to us as revenue, which we get paid on. There's approximately at full build out, there's $360 million of energy arbitrage and tax credits that will come to Overwatch Capital as revenue. And then ultimately, if we're able to solve that, these tech tenants could care less what they have to pay it is an absolute imperative for them to get in AI capable data centers in order to be able to advance their models and operate things like ChatGPT, to operate AI agents within Google that help you out and that give you information when you ask it questions, and the other myriad of AI powered language models and AI powered processes behind the scene. It is absolutely imperative that we have data centers that are AI capable in order to do that, or this technology advance that we're all witnessing halts and stops. So there is no mountain that these tech companies aren't willing to climb to get this done.
And my next question was that I really enjoyed the conversation you and I had last week when I made that video on 10xing, and you spoke about moving the needle. Now, for our investors that are here, just maybe if you want to stop sharing so we can see you properly, in terms of what is that principle of where you sit with your investors and you show them how to sort of move the needle so that they like you just explain in a bit more detail, because I think you've mentioned it a couple of times already tonight or today, depending on what time zone you're in. But the point being is that this is something that is generational. Like, this is a massive opportunity in not only right now, but over the next decade or more. And for investors who understand it, they can really move the needle, as you said.
Yeah. Guys, there's something I talk about a lot, and it's what I've practiced in my own portfolio. I've as I said, I started in venture. I then moved into private credit, so I was originating loans, then launched a venture debt fund within that pretty large private credit company. And then I was a partner at an industrial firm where we bought industrial businesses and real estate. So I've worked over the spectrum of the alternative asset landscape, meaning, just everything that's not public market investments. Though through my personal portfolio, and I was taught by people who are much more successful than myself, and this mirrors how they invest personally as well. I have public stocks, obviously, that I manage and keep some liquidity in. I keep some liquidity on hand for great opportunities. And then ultimately, I do invest in some private credit, which creates, nice cash flow income to me. I invest in core real estate. These are good, stable, real estate that'll 2x over, 8 or 9 years. That doesn't, you don't want to take a lot of leveraged risk in real estate and be really risky and try to hit these more tertiary or smaller credit tenants. So I'm careful and pretty conservative in my real estate investing. And then I will take both platform level. So this is an example of a platform level investment, and venture investments. And that's where I try to take very, very mitigated, but I take risks to what I call move the needle. And when I say move the needle, what I mean is there's a certain escape velocity when you're looking at capital. And I'm going to use this in terms of US dollars. Feel free to apply it, to your own area of the world here. But when you look at, let's say I take $100,000 and I turn that 100,000 into $200,000, fantastic. Everybody's happy with a $100,000 profit outcome. Here in the States, if I take 100 and turn it into 200,000, my life doesn't change, right? There's nothing meaningfully more I can do with turning 100 into 200. Now, of course, I want to continue to do that safely. But when you have an opportunity where you can safely turn your 100 into 700, 100 into 800, and have that kind of upside, that doesn't mean you'll hit it. You may only 2x it. If you shoot for 10x and you 2x, well then, hey, there you go. But if you have an opportunity to meaningfully move the needle, there's a lot I can do with $700,000, right? So if I invest 100 and turn it into 7, that's a exponential increase. We call that escape velocity. That's the ability, hey, now I can this actually changes, my lifestyle, or this actually changes the kind of deal I can invest in. This allows me to invest 7 times as much money. That's the kind of escape velocity deals like this provide. Unfortunately, they're simply not available to most retail investors unless you're extremely high risk. You're throwing it in some crypto, altcoin. I like Bitcoin, but I'm talking about, some of these moonshot coins, or you're taking some, some kid graduated Stanford and he's got a great business idea, and you're throwing it behind that, hoping and praying that this guy's a good CEO, he can run a company, where 90% of them fail. So you have to have, unfortunately, these deals that are both ran by highly sophisticated, successful teams, and very well connected are very, very challenging to get into because they simply don't take $100,000 checks. They're wanting to talk to people that can write $10 million checks because it's more efficient for them. They don't have, these are sophisticated teams. They don't have time to get on and take, how are you going to raise, how are you going to raise $1 billion on $100,000 checks? That's just not, it just doesn't make sense. So, typically you can't gain entry into these deals. Excuse me.
Awesome. Okay, so I just want to show people very quickly if they're excited by what they're hearing and what they're seeing, how one can participate. So you literally go to Wealth Migrate, you go down to the deal, it's live on the platform, and you basically can read all about it. You can, the webinar will be up here now that we've got the recording. You can see from a risk perspective, it's opportunistic. You can go read all the different, read all about it. You can look at the risks, you can see the timelines. And you can also download. So this is the investor sort of deck that Ryan's just taken us through. Now, let's assume that I like this deal and I want to participate. So I effectively go invest in this deal. At the moment, the minimum is $1,000. I literally go continue. I digitally sign the agreements. I can download them if I want. And I go agree and I go make investment. And you've just seen me invest in a data center, which I think is extremely, extremely exciting. So there it is in terms of that process. So I just wanted to show everyone it's there. If you do want to invest $50,000 or more, you can go to Private Wealth Global, and there's a 50% discount in terms of the fees. So in terms of that process. So what I wanted to do now was I've got there's a couple of questions that are coming through here. I just wanted to put up a poll for everyone. In terms of, let us know what you think in terms of what Ryan and Tyler have shared. Alex, I know you said you had some questions. Before we go there, I want to summarize what I heard. Now, I've got quite a few slides that I can take people through, and I'm not going to bore people with slides, but I will put them up in the platform, because what I've done and how I always do this is I've gone through why the country. So what is important with regards to America and why do we need to know what is going on? Then I've gone through why data centers and what are the key things with regards to data centers in terms of the overall process. Then I've gone through the asset class. Why is this such an important opportunity as an asset class? And again, you'll be able to read through all of this in terms of the process.
Yeah, but I'm not sure if you're sharing the slides. We're still seeing the platform at the moment.
Beautiful. Thanks, Alex.
Sure.
These slides, I've got so confused since they changed my screen. Okay, let me just go back quickly. So what I was trying to show was I put together a slide deck that basically summarizes everything. And I'll also do a summary document from this event. But if you look here, why the country? So it's all about why America and why the opportunity. Then effectively we go why data centers, the sector, and the whole process. Then we go to the asset class, why AI-ready data centers with clean energy are important. And we basically take you through that process. The next one is the partner, why Overwatch Capital, and why it's so important, who the team is, et cetera, et cetera. And then finally, it's the deal, why this specific opportunity in terms of this process. And I know that Ryan's already taken us through this, but effectively it's a $30 million raise, and we've got the ability to participate in it, which is truly, truly exciting in terms of being able to participate along a company that has got $30 billion on their balance sheet and $100 billion in revenue and one of the top 20 firms in Japan. You get to participate alongside them in terms of the process. So the target returns are 7x equity model. Again, reminding you, putting $100,000, that means it's $700,000. You're looking at an IRR, internal rate of return, of roughly 30% over 9 years. You get a partial liquidity at year 6. So you get 2.5 times your money back at year 6. And then you can just see the sites of where they are, who the tenants are, what the exit options are in terms of where they're at, and then what is the security in terms of that process. So I put that all together to make it nice and easy for you. And in simple terms, there's a summary. And I just wanted to use this to summarize what we've been through. So the first thing that's important for me is why America? And there's $5 trillion of investment in AI infrastructure in this boom. In terms of, and there's a lot of energy bottlenecks. I'll literally start off tonight telling you about that. And also it's very important to have geographic location. So all of those are this is, by the way, according to McKinsey's, Secondly, you've got the sector. Why data centers? Well, you've got a massive storage shortage of computing power. There's hyperscaling, outsourcing, and you've got an infrastructure play. So this is all about building infrastructure for the future. The asset class, why AI and clean energy? Well, you've got the microgrids, you've got resilience, and you've got ESG. So for those that want to, green and everything else, ESG is environmental and social governance. The partner, why Overwatch? Well, you got a veteran-led team, institutional backing, and you got the ability to get into the deal that literally, you wouldn't get in if it wasn't through relationships in terms of that process. And then finally, the deal, why this opportunity? Well, you got a 30% IRR, and you've got massive, well-known tenants in terms of the process, and also you've got multi-sites. So you're not just investing in one deal, in one building. You're actually investing across multiple sites and investing at the institutional round within Overwatch. I'm not sure if there's anything I'm missing, Ryan, that you would add to that, but I always like to try and summarize it and make it easy for people so that in one place they can see it all in one slide.
Yeah, I think one point to add, and I saw a good question I want to answer as well, but a good point here, guys, is what the reason I like GP. This is called like a platform investment, or a GP stakes investment is what this is called. And the reason I like this is because, on a project level, we're going to try to get into some of the project level as these start getting built out as well. I'll try to offer those, Scott. We can talk about those as well. We'll circle up after this. No promises that I can get in on those. These are we're lucky to get in here, but this is where I wanted to get in the most. And the reasoning is, remember, the GP on a project level, only, and really LPs as well, only really make money upon the success of the deal on the back end. We create a layer of safety when you invest in the platform, because the GPs make fees and things like that up front on the front end. So in a worst case scenario, there's already a significant amount. Let's just say, for example, let's say I build a $5 billion venture capital firm, and I invest in a bunch of businesses over 10 years and they all fail. Well, I've been taking a 2% asset management fee on these businesses for various years. There's some protection if you're invested into the GP stack, because you've got that early cash flow even if things go bad. That was obviously an aggressive example, but the point I'm trying to make is there's an extra layer of protection, not only with the multiple assets, but also because GPs make money up front through fees, energy arbitrage, et cetera, that we take part in. And they can't make money without us making money. I saw somebody ask two great questions I'll touch on really quick.
Before we go to the question, because I just, before people go, I just want them to hear one more thing. It's really important. Timing. So one of the challenges here was, 10 years ago, I'd been telling people about medical. We all got very excited about it. We finally got a deal, and we raised $6 million for that deal. The thing is, we had a bit more time. Just talk to us about the time here, Ryan, because it is a challenge. It's an amazing deal, but unfortunately, there's not a lot of time in terms of people being able to participate.
Yeah, so I had to send my wire on October 16th. So the timeline is tighter here. The reasoning behind that is these companies are moving fast. I'm following this Japanese conglomerate coming in. Once the round's closed, they want to move forward. Our $2 million in the grand scheme of a $30 million check is not a meaningful amount of money. These guys are used to, these are very institutional folks used to very large check sizes. So in order to participate, the benefit that I was able to bring to the table is I said, hey, this $30 million check's coming in chunks towards the end of the month. They have a lot of expenses right now. The partners are just paying out of pocket for these buildings that are sitting empty right now as they're signing leases, going through all the engineering, all the due diligence with these large companies. And I said, hey, how about, if I can get my money in fast, that'll give you guys a little runway so you're not coming out of pocket as you're kind of working through all these. Now that the gas contracts are signed, they're working through all these lease negotiations with Oracle, Google, et cetera. And that was kind of my advantage. That was my way to kind of remember, my father-in-law's a partner, but he's a managing partner, but he has partners as well. So the familial bridge only goes so far. So that was kind of what we could bring to the table, is being able to move fast. So naturally, I have to come through on that and be able to wire early here. If we drag on, they're going to close the round and move on.
And just to, if you look on our platform, it's closing on the 13th because we've got to obviously still wire the money to Ryan and everything in between. So we've basically got the best part of a week, in terms of in terms of this process. So people need to move. They need to, and it's interesting, Ryan. We had an amazing self-storage deal about 2, 3, 4 weeks ago, and a lot of people lost out and missed out on that. And the message is, if you can't move quick enough for the next week, well, get your drop powder ready, because we're bringing good deals, and there's no point in talking about it, wishing and hoping. You got to be ready for these things. Let's go to the questions quickly. There were a couple of questions that I know Tyler very kindly has been answering them, but let's just look back and see if there's stuff that we want to go through.
There's a couple key that I like. Here's the gas grid sourced locally or offshore. This is United States gas. These are United States natural gas pipelines. There's a great question that said, hey, if the technology is old in the data centers 10 years now, will it be old in our 10-year deal? What I'm saying about the technology is not the actual racks that are plugged in. Those are pulled in and out when NVIDIA releases a new powerful chip. It's not as simple as pulling it in and out, obviously, but that's not the technology I'm talking about. The technology is the microgrid technology that is able to cool these things. AI pulls. I don't recall the number off the top of my head, but the amount of heat difference between an AI capable data center and a regular data center is immeasurably different. So these have to be, you can't these older data centers that are old, dated 10 years, you can't just like, hey, here's an updated chip, let's plug it in. They would have to be completely gutted and completely redesigned. A lot of these don't have land around them because they didn't need a microgrid. So you notice all of our data centers have a lot of land to expand onto. Some of these data centers are in metro areas that have now built up around them. They don't have anywhere to go. So this has to be purpose-built, purpose-designed. Most of these data centers would have to be gutted and completely, the actual technology that runs the data center, not the chips, the technology that runs the data center would have to be completely revamped and redesigned. And it's just not cost effective and sometimes not possible due to acreage restraints. So yeah, that's what's created this great bottleneck, is that these things have to be designed. Their initiation has to be designed for AI capabilities. So that's kind of what I mean. So to answer your question, no, but unless we have acreage to expand. So even if microgrid technology, cooling technology gets better, we have plenty of room to be able to build that out and utilize and leverage that new technology. And there was one more in here. No, so again, on the cash on cash return, yeah, guys, there is some cash coming. One, there's construction timelines, but after that, of course, there is some cash coming in. But I think it's Tyler answered it perfectly here. The economic convenience. Obviously, they're not going to send us $1,000 checks, right? So that it's going to have to be a measurable amount. That's very standard in large companies. But yeah, this is a longer term play where you're waiting on these large data centers to be built out and tenants to move in. This isn't a quick, fast, easy money, but this is an institutional, large, needle moving play that ultimately is going to enable you to have a very measurable difference at the end of the road here. These timelines can shift and change, of course. It is a big project, but it is the kind of project that creates wild income.
And I think this is, I like this, this document is in the deck, but it just sort of sums it up in kind of logic, in terms of where we're at, the construction build out, the stabilization. It just gives people an easy understanding of the timelines, etc. So,
yeah.
In terms of that process. Alex, any thoughts or questions from your side? You said that you had some questions. And just by the way, the survey's up. I'd love people to fill in the survey. We'd love to get your feedback. So give us, fill in the survey, fill in the poll, let us know what you're thinking.
Yeah, Scott, I think most of the questions have been answered, to be honest, Ryan. I think that was done very well and very elegantly. So well done to you. So I think, yeah, one of the things that I'm just trying to understand a little bit better is it sounds like we are investing in the property as well as the tech that will be built around it. So I think one of the questions that's just kind of bubbling for me is, I get the triple net lease aspect of it. That's the property side. But are we as a institutional investor, also investing in the tech that's going to be installed by itself, into the building itself?
Sure. It's great question, Alex. So we're actually investing into the management company that owns and operates these data centers. So for example, let's say I launch a company, just on a simple example, I launch a company that is going to build a bunch of houses in a suburban neighborhood and sell those houses, right? So instead of just investing in one house, you're investing in the actual company. So all the money, now there's going to be investors in the houses and banks involved, but all the money I make as the GP, you take a top line revenue share of. So that's what we're doing here. So Overwatch owns the data centers, excuse me, owns the data centers. They own the proprietary technology for the modular data racks. They actually absorbed another company that my father-in-law was an owner of. And they own, they operate these data centers. And for that, obviously, they take acquisition fees, development fees, et cetera, to get these things up. And then obviously they receive, like an 80-20 split on the revenues, right, with their investors on a project level. So all that money that flows into Overwatch across all of its projects, we take a revenue share on.
Gotcha. And then in terms of triple net lease, that will be the tenants will then take care of obviously the risk, and the tenants will be AWS and all the names that you mentioned. So
Exactly.
we're just getting the property up and running, set it up properly, get the tech in, and then basically from there it's smooth sailing.
What I like about these projects is after the lease is signed and the tenant moves in, it's not a question of, hey, can we sell this thing? Can you sell a property that has a 15-year net lease with Google? Yeah, I hope so. So, this is that's like, it's like you don't see a lot of Ferrari ads on TV because they're pretty sought after, right? So in the same way, it doesn't take a lot of marketing to sell a 15-year net lease Google project, and there's fortunately only a handful of companies that could afford one. So it's pretty easy to make those calls. You don't need to run a large marketing campaign for 3 years. So the risk here is all in the construction, the build out phase. This team has built out data centers. They have built out energy microgrids actually for the Department of Defense, the Pentagon, U.S. Navy. So this team's militarily connected. One of the managing partners, a 15-year Navy SEAL chief, before launching, very successful technology firm, going to Wharton, and then he made a career in technology. So these are very well connected and very high purpose individuals. And so that's the play there. The risk is all in that construction phase, and it's typical large construction risk, right? Of course, things can happen, but after that point, it's smooth sailing, as you said.
What is the acreage available for growth?
So if on those, I think it's there's a slide that shows the buildings. It ranges. So these buildings are between 200,000 and 375,000 square feet. Each property, we have a property with 230 acres. I think the smallest property has 10 acres around it. So, we certainly don't need 230 acres for any technology that I'm aware of. But yeah, so I think you see here 210 acres, 230 acres, 13 acres, 199 acres. So these are coming with significant acreage around them. And all these buildings are purposely positioned close to the longitude and latitude marks of backbones. Backbones are the big fiber optic wires that run under the ocean from America to South Africa to London, et cetera, et cetera, et cetera. So they're purposely positioned close to those for latency reasons, and then also positioned just outside of major metros so that they can get the acreage, but also have strong latency and speeds.
Awesome. Okay. Well, I think we're on the hour. I really appreciate your guys' time. And Alex, I'm not sure if there's anything else from yourself or for anyone else, any other questions. I think really for me, the purpose of today, whatever time zone you're in, is you could go and read all this document. You can look at my PowerPoint. You can read the summary document that I'll do after this. But the whole purpose here really was to come and meet Ryan, come and meet Tyler, understand who they are, understand what their connection is with Overwatch, understand how you effectively are getting a seat at the table that you would never get unless you had relationships. And no disrespect, but even if you had $10 million, you wouldn't be getting a seat at the table. And for me, what is truly exciting, Ryan, is that you and I our two companies are very aligned in terms of democratizing access and allowing everyone to invest like the top 1%. And, opportunities like this, quite frankly, I think for many people, they'll be sitting there and thinking, this sounds too good to be true. But the reason being is they're just never invited to the table. They're used to their paltry 6-7% returns that the retail investor gets. And why this is an eye-opening opportunity for everyone is that now they start to realize what are the top 1% are doing? How are they participating? What are the assets they're investing in? I think what is so exciting is with technology and with relationships, everyone can now get a seat at that table. And so my strong recommendation for people, go and look at the document, go make some decisions. If you're going to invest, participate. If it's too late for you on this one, well, Ryan and his team and Alex and myself and Paolo on our side, we look to bring more opportunities, but not necessarily the opportunity to be right at the GP level, which basically means right at the top. Okay, if you don't speak LP GP, you don't even have to. It's just basically investing right at the top. So, do you want to invest here, or do you want to go right to the top? And so, Ryan, I just want to say thanks so much for the invitation, for the opportunity for our investors, and specifically, I know you come in to talk to our mastermind in a week's time or whatever. So I look forward to going into the dynamics of how partnerships work and some of the different asset classes that you're going on. But for tonight, let's just focus on this opportunity. And I just want to say thank you to both of you. It's really awesome. And Paolo and Mercer and the rest of the team that literally worked all weekend, because you sent it to us Friday. They worked all weekend to get it live. Everyone's working backwards to make this opportunity relevant for everyone.
Yeah, well, thank you so much, everybody. I appreciate you coming along. And yes, Scott said, democratizing these opportunities is why we built the company. I've been very successful in my personal investments, and a lot of that was due to being able to be connected to the right people. I've led personal investments that went well, but the ones that I ultimately had the connections on, had lever pullers is what I call it, or what created a substantial amount of my wealth. So I wanted to share that network connection and ultimately be able to offer that to a wider group of people. And that's our purpose here. So certainly aligned there. Thank you all. We appreciate your time. Thank you, Scott and Alex for having us on. And we look forward to everybody.
Awesome. Okay, guys, if you want to still fill in the survey, go for it. I'll stay online just for a little bit if anyone wants to ask any other questions. But Ryan and Tyler, appreciate your time if you need to duck.
All right. Thanks, guys.
Awesome.
Thanks.
Cheers.
Thank you, everybody.